Okay, I'd like to talk about the pension income credit and the need for many people to generate $2,000 of pension income. The pension income credit has been in for a number of years, and it allows people to earn $2,000 of qualifying pension income and pay just a wee little bit of tax. Virtually tax-free, this $2,000. Many people will have registered pension plans because they worked for the government or for a large corporation. So they're already covered off. I'm not talking about them. I'm talking about people that don't have a pension plan through employment that would use their RRSP to give them this pension income. So these people, you must be 65 or older, and if you receive money from a RIF or an RSP annuity or a prescribed annuity, those income amounts qualify for the pension income credit. For most of you, you will not have transferred or converted to a RIF yet. So I'm really talking about the people from age 65 to 71. For those people, what they should do is, if we assume they have a $50,000 RSP, they should move $2,000 of it into a registered income fund and then take that out. And they would do that in the remaining month of 2010, because this is each year that you get the credit. So you would go to your financial institution, move $2,000 from your RSP into a RIF, and then take that money out of the RIF. For couples, it would be a good idea for one of you to move $4,000 from the RSP to the RIF, and then take out the $4,000 from the RIF. Even though you only qualify for a $2,000 pension income credit, you can use the income splitting provisions to split $2,000 over to your spouse, and then she would qualify for this same preferred treatment on pension income. This may not apply to you because you're only 30 years old. However, you may have a father or a grandfather that's in this age from 65 to 71. You should bring it to his attention. Is he doing this? This would be a great way to start taking money out of his RRSP and not having to pay any tax on it. Of course, if you help your father or grandfather, you're likely to get a larger gift at Christmas time. Thanks.
Hi, my name is Wade, and I'm here to talk about some exciting planning regarding capital losses. Now, if you're expecting capital gains on your 2010 personal tax return, or you've had capital gains in the past 3 years, well, then this news is going to be of particular interest to you. Now, maybe you've got some investments right now that have gone down in value, and you're not expecting them to go up in the foreseeable future. Heck, you might have been considering selling off these investments already, but just needed a little shot in the arm. Well, I'm here to tell you that if you sell these investments and trigger capital losses, these losses can be applied against capital gains in either the current year or carried back and used against capital gains in the past 3 years. To show you a little bit more about how these calculations work out, let's go to the board. So you have a capital loss of $10,000 in 2010, half of which is allowable. So you carry it back to 2009, where you paid tax at a rate of 36%. Well, that equals a savings of $1,800 right in your pocket. Remember, if you want to take advantage of this planning on your 2010 tax return, you're going to have to trigger these capital losses by the end of the month. And also note that if you sell an investment at a loss and buy back that same investment within 30 days, the capital loss will be denied. So don't do that. Hi, it's Wade again. Now, if you're planning to claim employment expenses on your 2010 personal tax return, please have your employer sign a T2200 form. This form, known as a Declaration of Conditions of Employment, is a support that Canada Revenue Agency requires to allow such employment expenses as vehicle expenses, home office, and anything else that you have to pay for as part of your employment duties. Now, it's better to have this form signed sooner rather than later, so you're not scrambling to get your employer to sign it during personal tax season. Thank you.
For clients that have purchased U.S. real estate, please be aware there is a significant U.S. estate tax. Please feel free to phone the office to discuss some tax planning options in order to mitigate the significant tax liability at death.
I'd like to talk about self-administered medical plans. These plans are applicable to small business corporations and their shareholders. I've advised most of our clients to adopt them. Adoption usually means having a statement of the company medical plan up in the coffee room. If that coffee room happens to be in the kitchen, I guess that's where the notification would be. The advantage to a self-administered medical plan is that we're avoiding the punitive calculation for medical expenses that appears on a personal tax return, and we're also getting the benefit of not having to earn income at a high rate of tax. Instead, the medical expense is simply paid for by the company. So if we look at what happens in many cases, let's say that somebody needs to cover $2,000 of medical expenses. Okay, so to pay for these $2,000 of medical expenses, they would have to earn $3,125. Okay, that would be their gross pay. Then the employer, which in this case would be your small business corporation, would have to deduct tax at say 36%, which that tax would work out to be $1,125, and that would leave the individual with net pay of $2,000. He would then use the $2,000 to pay for the medical expenses, and he wouldn't have any tax left. How much of a write-off will he get when he completes his personal tax return? Let's look at the calculation. Well, the medical expense is $2,000, but you have to reduce your claim. There's this reduction, which is 3% of your net income. So if your net income were, say, $50,000 as an assumption, that would be a reduction of 3% times 50,000, which is equal to $1,500. So the only amount you'd be allowed to claim on your personal return would be $500. And how much tax would it save you? Would it save you tax at your rate of 36%? No. The rate is 25%. So you'd only save $125 in tax from paying out a $2,000 medical expense, of course, after you pay tax to the government of $1,125. So the net cost here, let's see, your company had to pay you $3,125, and the medical expense was $2,000, and there was a bunch of tax, but then you saved $125. So the real cost of this whole thing was $3,000. The $3,125 less the $125 refund for the medical expense. The real cost was $3,000. If we had a self-administered medical plan, the company would pay the medical expense on your behalf. You could pay it first and then ask for reimbursement from the company. What would the cost be? Cost would simply be the $2,000. Wow. A medical expense of $2,000 that ends up costing $3,000 after tax, or simply $2,000. So the self-administered medical plan is a very smart way to go. Thanks very much.
Hi, I'm Nolan Hergott. For individuals that own registered investments, like an RRSP or a tax-free savings account, and non-registered investments, a little planning could go a long way. Canadian dividends and capital gains are subject to much more favorable tax rates than other investment income. Therefore, it's often good planning to own investments that earn these types of income in a non-registered account. In contrast, it's often a good idea to hold investments that earn interest income, other income, and foreign income in a registered account, as they are not subject to as favorable tax rates.